I feel like a lot of people they still have those lingering fears from the 2008 crash. And they know that risky or, subprime lending was a huge part of that. I think one thing that would be really interesting for our audience to hear is kind of a summary of how we got into that place and what we're doing differently now that can help, the average consumer who might be going for something like a mortgage feel more confident.
Okay, so when 2008 happened, there were a couple of things that were going on. So one were these low doc loans that allowed people to get mortgages that they would not have otherwise qualified for because they didn't have to provide information to the bank showing that they had the income to cover that loan that they were taking out. Another thing is adjustable rate mortgages, and so specifically like ARM mortgages. They can be 3-year or 5-year or 10-year mortgages. People were using those mortgages to get into a house and make it more affordable, because in an adjustable rate mortgage or an interest only mortgage, you're just paying the interest due and none of the principal. But the problem is that you'll end up with your payments will balloon over time, because at some point you do have to start paying those deferred principal payments. Also, you're subject to interest rate fluctuations. So as interest rates rise, now your payment is rising. And so now a house that was affordable is suddenly not affordable at all. And then, of course, we had a lot of even worse predatory lending going on with a lot of bait and switch, where these lenders would say that they were giving, say, a conventional mortgage at X interest rate, but really it was an interest only mortgage or an ARM, or it was a conventional mortgage at a much higher interest rate or with much higher fees. And so then that type of predatory lending then set us up to be in a position where, we had all of those foreclosures, and then also there was the securitization of all of those mortgages as well. And so then it impacted our financial system in really horrible ways. And so I would say, in terms of how the things that we have in place now to protect us from that, is that now banks are actually required to show that the mortgages that they are originating are actually affordable. So they have to show ability to repay, and there are regulations around what constitutes ability to repay, what percentage of someone's income they can say is affordable when they're devoting that income to their mortgage. And so that really helps, because if the bank isn't meeting those affordability requirements, then that kind of already paints the bank as a bad actor. If something bad were to happen to that mortgage, then the bank is going to be basically automatically at fault. And again, I would say that the actors that did that it wasn't all banks that were doing that. There were a lot of banks that were still lending responsibly during that time, but, unfortunately, it doesn't take our entire banking system to be corrupt to have these huge negative impacts. So that's why it's so good that we have agencies like the CFPB that are not just looking at what's going on now, but trying to anticipate what kinds of issues might be coming up as new financial products are created.
Now, when pre-2008, those lenders were misrepresenting the types of mortgages that someone was entering into, was that illegal at the time?
Yes.
So they were just straight out breaking the law. Are there things that everyone going into something like a mortgage should know to look for to be certain that someone's not getting one over on them?
Yeah, so another thing that has happened since 2008 is the disclosures that you receive when you buy a house. They have completely changed, and they're now, the truth in lending disclosures are now made in a way that, in theory, a person should be able to clearly see what they're being charged, how much the loan is going to cost them, what fees that they're going to have to pay. So when they're shopping for a mortgage, what they'll want to do is shop around at different mortgage lenders, get those truth in lending statements up front so that they can compare the lenders. And then by law, the lenders can only vary their fees within a certain tolerances, very small tolerances. And otherwise the lender has to actually pay the customer back. So that's one of the things that we would check as regulators to make sure that their fees were within the tolerances. Otherwise, they'd have to pay restitution to any borrower.